the worst Asian performer of the year, down more than 6% in 2025. That is the Indian rupee for you. The end of the year is near, and it has been one of the worst years for the Indian currency. The rupee has breached one psychological barrier after another this year, crossing the 91 to the US dollar level on Tuesday, the 16th of December, with 10 more sessions to go. The slide has been relentless, from just below 85.50 in the new year to a record low of 91.08. It took 9 trading sessions for the rupee to fall to 90 from 89. The fall to 91 took another 9 days. It is not just only the dollar that the rupee has fallen against. Rupee has depreciated 16% against the euro, 12% against pound and 9% against Chinese yuan in 2025. What is surprising is the rupee trading contrarian to the state of the Indian economy. India's GDP remains resilient. The GDP growth clocked in at a whopping 8.2% in July to September quarter, and both the manufacturing and services sector are flourishing. It is the global headwinds which have played havoc in the rupee. The persistent foreign capital outflows from the stock markets to a tune of $18 billion this year. Fears of a widening trade deficit despite the November numbers being unexpectedly low.
Capital slide at one point, rupee depreciation is supporting is primarily because there has been no major trade deal announcement from the domestic front as yet. Over the last few months, most of the larger economies have come to the table and have a discussion with US and have a settlement. From 150%, China is now down to 20%, but India still continues to be around 50% mark as far as tariffs are concerned. And for the last 3-4 weeks, we've been time and again having a positive confirmation that trade deal positive talks are going on, but nothing has come on the table as yet.
And stalled India-US trade deals talk, which have ensured continuing high punitive US tariffs as high as 50%. All reasons are a perfect storm. All eyes are now on Reserve Bank. Will it intervene at 91, or is it this the new normal for the Indian currency?
We allow the markets to determine the prices. We believe that the markets in the long run especially are very efficient. It's a very deep market. Our effort has been always to reduce any abnormal or excessive volatility. And that is what we will continue to endeavor. Our external sector, as I also mentioned in my statement, is very strong going forward. We do believe that we are having sufficient reserves.
For the industry, it is double-edged sword. While the IT and pharma sectors see a silver lining in dollar earnings, the cost of manufacturing and shipping is soaring. For CXOs, the math is getting harder. Importing raw materials is now 6% more expensive than last year. For companies with foreign loans, the debt burden just grew heavy overnight. Foreign portfolio investors are also avoiding Dalal Street as they see their returns diminish with a weaker rupee. The common man feels the pinch at the checkout counter, where electronics and imports are costlier. Overseas education and that dream vacation are suddenly out of reach for many. And a weaker rupee neutralizes the impact of falling crude oil prices, keeping the import bill high for the government. However, for the hundreds of thousands of households receiving remittances from family abroad, the weaker rupee means more bang for the buck. Bureau Report, Business Today Television.